Okay, let's unpack this. It is the morning of February 2nd, 2026. The Walt Disney Company just dropped its Q1 earnings report. And if you're just glancing at the headlines, honestly, it looks like a victory lap.
On paper, it is a stellar report. I mean, probably one of their best in years.
Right. I mean, look at the top line numbers. Revenue is up 5% year over year, hitting almost $26 billion. They beat the earnings per share estimates Wall Street wanted, what, $1.57? Disney delivered $1.63.
And the parks division alone cracked $10 billion in revenue for a single quarter.
Those are just massive numbers. By all traditional metrics, that is a solid beat.
A huge beat.
Exactly. But, and this is the paradox we really need to figure out today, if you look at the stock ticker right now in extended trading, the arrow is not pointing up, it's pointing down hard.
It was down about 7 or 8% in after-hours trading last I checked, which, for a company of Disney's size, that's billions of dollars in market cap just evaporating.
In minutes, which feels wrong. You know, it's like getting straight A's on your report card and your allowance gets cut immediately. That's what happened to Disney this morning. So that's our mission for this deep dive. We're going to look under the hood of the Mouse House. We need to figure out why a seemingly great report triggered a sell-off. Is the Disney magic actually back? Or is Wall Street seeing some cracks in the foundation that the rest of us are missing?
And to do that, we have to look past just the headline numbers. We need to talk about the content engine, a really significant shift in streaming strategy, a genuinely surprising deal with OpenAI, and then finally, a cash flow mystery that I think explains that stock drop.
Okay, so let's start with the visible stuff first, the movies. Because looking at the sources here, 2025 was an absolute monster year for Disney at the box office.
And it really was.
And it feels like just yesterday, everyone was writing op-eds about superhero fatigue or, franchise fatigue.
Those narratives seem to have vanished, haven't they? I mean, Disney generated over $6.5 billion globally in ticket sales in 2025. That puts them back at number one for the 9th time in the last 10 years. They basically reclaimed the throne.
Let's look at what actually made that money. It wasn't, risky new IP.
Yeah.
We're talking Zootopia 2, which grossed $1.7 billion.
An absolute juggernaut. It's now the highest-grossing animated film ever.
And you had Avatar, Fire and Ash crossing the billion-dollar mark, Lilo and Stitch doing huge numbers too. That's $3 billion movies in 1 year.
It's just absurd scale.
But here's where I want to push back a little. Is this just nostalgia bait? Are they just printing money by rehashing old hits? Or is there an actual business strategy at play here beyond just make sequels?
There is, and this is what Bob Iger was really stressing on the call. It's the ecosystem effect, or what they used to call the flywheel. This is the part most people miss. A hit movie today isn't just about box office. They released data showing that the theatrical release of Zootopia 2 drove this massive viewership spike to the original Zootopia movie on Disney Plus.
I saw that stat.
Yeah.
First-time streams for the older movies approached 1 million, and hundreds of millions of hours were consumed.
Exactly. So the movie marketing becomes streaming marketing. It acts as a customer acquisition tool for the platform, and then you connect the dots to the parks.
Right.
The Zootopia land in Shanghai Disneyland is apparently seeing huge attendance drivers, specifically because the franchise is hot again.
So it's the circle of life. Literally. The movie drives the streaming drives the merch drives the flight to Shanghai.
Yeah.
And then you build a land to keep them coming back.
Precisely. It's a self-reinforcing loop. And they seem very confident this is going to continue. They listed the 2026 slate, The Devil Wears Prada 2, The Mandalorian and Grogu, Toy Story 5, Avengers, Doomsday. It's a heavy hitter lineup.
Okay. The Devil Wears Prada 2 is the one I'm keeping an eye on personally. But let's pivot to the screen in our living rooms. Because for years, the narrative around Disney Plus was growth at all costs. It didn't matter if they were burning cash as long as the subscriber count went up. I remember reports saying streaming was losing them, $4 billion a year?
It was a cash incinerator. But that narrative is officially dead.
Dead and buried. If you look at this Q1 report, the streaming business isn't just not losing money, it's undeniably profitable.
Yeah, they posted operating income of $450 million for the quarter, and the earnings growth in that segment is roughly 50%.
That is a massive turnaround in just a few years. How are they doing it? I mean, I know my subscription price went up, but is it just price hikes?
Pricing is part of it, for sure, but the real strategy here, and this is the key takeaway for anyone interested in the subscription economy, is bundling.
The duo and trio plans, putting Hulu, Disney Plus, and now Max together.
Right, but it's not just about giving you a discount. The really key insight is about churn. They found that subscribers who are on a bundle, They have significantly lower churn rates.
Okay, let's define that for everyone. Churn basically means people canceling their subscription, right?
Exactly. Think about how you use streaming. If you just have Disney Plus churn, you might sign up to watch the new season of The Mandalorian. Once the finale airs, what do?
If there's nothing else I want, I cancel. Guilty as charged. I've definitely done that.
Most people have. We call that cycling. But if you're on the bundle, the calculus changes. You finish Mandalorian, but you don't cancel because you're halfway through The Bear on Hulu or you want to catch a game on ESPN. The service becomes sticky.
So the strategy isn't just get more people, it's lock the doors so they can't leave.
In a nice way, yes. By intertwining the services, they make the decision to leave much more painful. And it's working. They are now targeting a 10% operating margin. They've proven streaming can be a real sustainable business.
But speaking of keeping people on the app, we have to talk about the wild card in this report. The thing that made me stop and reread the transcript because I thought I was hallucinating?
The OpenAI deal.
The Sora agreement. This was definitely the surprise of the morning. So lay this out for us. Disney has signed a 3-year licensing agreement with OpenAI to use Sora.
Yeah, their video generation model.
Oh.
But, and this is key, they aren't using it to make the next Avengers movie.
No, absolutely not. The report is very specific. They're going to use it to create curated video clips, about 30 seconds long, using Disney characters.
And they have set these really strict constraints. No human voices and no human faces.
Which I assume is a very deliberate line in the sand to stop the Actors Guilds from burning down the studio.
Almost certainly. They are trying to thread a needle here. They want the tech, but they don't want the backlash of replacing actors.
But look at why they're doing this. They want to put these clips on Disney Plus to add what they call short-form content. To me, that just screams, we want to be TikTok.
That's exactly what it is. It's an engagement play. They know that passive viewing, sitting down for a 2-hour movie, is competing with the dopamine hit of scrolling through short videos on your phone.
So the idea is, I open Disney, plus I don't have time for a movie, but here's a stream of 30-second AI-generated clips of Stitch destroying a kitchen or Olaf telling a joke.
And suddenly you've been on the app for 10 minutes.
Correct. It addresses the productivity and connectivity goals Iger mentioned, but here is the really futuristic and, frankly, risky part. They hinted at the possibility of letting subscribers generate their own videos eventually.
Whoa. That is the part that feels like a massive pivot. User-generated content inside Disney Plus Salt. That's a huge shift from we are the premium storytellers who handcraft every frame.
It moves them from being just a broadcaster to being a platform. It creates a level of interactivity they've never had. But you hit on the risk. Does it dilute the brand?
Right. If anyone can make a Mickey cartoon, does a Mickey cartoon still feel special? Or does the feed just become flooded with, low-quality AI noise? That's the tension. They would argue they're chasing the audience. If the audience is on TikTok making remixes, Disney feels they need to offer a similar experience inside their walled garden, or they risk becoming irrelevant.
It feels like a high-stakes bet on the algorithm over the art. But we'll see how that plays out. Let's look at the other place where the transition is just as painful. Sports. ESPN.
Sports is. Well, it's a bit of a good news, bad news situation in this report.
The viewership numbers look great, though. Best college football season since 2011. Monday Night Football had its second highest viewership in 20 years. People are definitely watching.
Well, people are watching, absolutely. And they just closed the acquisition of the NFL Network and Red Zone, which is a huge asset.
I saw that they have the linear rights to Red Zone now. Explain what that actually means.
Linear rights just means they can broadcast it on traditional cable channels, not just stream it. So if you have a cable package, you get that whip-around coverage of all the touchdowns on Sunday. It solidifies ESPN as the home of football.
Okay, so ratings are up. They have more NFL content. So why did the sports operating income drop 23%? That seems catastrophic.
It looks bad, yeah.
If everyone is watching, should they be making more money?
You would think so, but it costs a fortune to broadcast those games. The report cites higher programming and production costs, sports rights fees. The money you have to pay the leagues just to broadcast the games are just exploding.
So it's that classic revenue is vanity, profit is sanity problem.
Right.
They're bringing in cash, but they're spending a boatload to keep the NFL happy.
Exactly. Even though ad revenue is up, the cost to acquire that content rose faster this quarter. It's a squeeze. They're banking on ESPN Unlimited, their new direct-to-consumer app, to bridge that gap, but it's still early days.
So sports is popular but expensive. Okay, now we have to talk about the heavy hitter, the parks, or experiences, as they call it. This is usually the reliable cash cow.
And it still is. They cracked $10 billion in revenue for the quarter.
$10 billion. Domestic attendance is up 1%, which is impressive considering they had Hurricane Milton to deal with. And spending per person is up 4%. So we're still buying the expensive lightsabers.
We are, but the growth story here is shifting geographically. If you look at where they're spending capital, the excitement is really international.
Tell me more about that.
Well, they've got the World of Frozen opening at Disneyland Paris. They have the new cruise ship, the Disney Adventure, which is going to be home-ported in Asia.
That seems to be a theme. Asia is a massive growth engine for them right now.
It is. Bookings are up 5% for the year, but it's weighted toward the back half. So they're expecting a very busy summer, particularly in those international markets.
Okay, I have to stop you there because we have painted a picture of a company that is firing on almost all cylinders. $10 billion in parks, profitable screaming, huge movies. So I'm going back to my original question. Why is the stock down 8%? What did investors see that frightened them so much?
It's the cash flow.
A cash flow.
If you look at the cash flow statement, there's a line item for cash provided by operations. This is the actual liquid cash the business generated. Last year in Q1, that number was $3.2 billion. This quarter, it was $735 million.
Whoa, that is a massive drop. That's like a 77% drop. Did the money just vanish?
No, and this is where you have to be a bit of a detective, or at least read the footnotes. It's not that the business stopped making money, it's a tax bill.
A tax bill.
Yes. Specifically, federal and California state income taxes. In previous years, Disney was allowed to defer or, delay paying certain taxes because of disaster relief related to wildfires in California.
Oh, I remember that. So the government basically said, hey, there's a crisis, you can pay us later.
Exactly. Well, later has arrived. They had to make a massive catch-up payment this quarter. It's a one-time hit. It doesn't mean the business is broken, but when you see cash flow drop from $3 billion to under $1 billion, algorithms and knee-jerk investors hit the sell button.
So it's an accounting anomaly, a very expensive one, but an anomaly.
Largely, yes. If you strip that out, the underlying operational health is actually quite strong. But in this market, cash is king. And seeing that number drop caused a panic.
That is the context I needed.
Yeah.
Because otherwise, it just didn't make any sense. It's like Disney paid off a massive credit card bill all at once, so their bank account looks low for a month, but they're actually debt-free on that front now.
That is a perfect analogy. The market hates uncertainty, and that drop looked like uncertainty until you understand the why.
Okay, before we wrap up, we have to touch on leadership. Bob Iger was on the call. He's nearing the end of his contract. Again.
And his tone was very much mission accomplished. He kept emphasizing how much better the company is now compared to 3 years ago.
He specifically mentioned fixing the streaming losses, getting creative output back on track. He basically said, I fixed it. It's ready for the next person.
Which implies the succession announcement might be coming sooner rather than later. He's trying to hand over a clean house. He wants his legacy to be the turnaround, not the turmoil.
So, to summarize, Disney has successfully rebooted its movie business. Streaming is finally making real money, parks are expanding globally, but sports costs are eating into profits, and a massive one-time tax bill made their cash flow look terrible, which spooked the market.
That is the nutshell version. It's a strong quarter disguised as a weak one by a tax payment.
And a dash of AI controversy on the side just to keep things spicy.
Always.
So here is my final thought for you to chew on. Disney is betting big on this OpenAI deal. They're effectively saying the future of engagement isn't just watching a 2-hour movie, it's watching a 30-second AI clip of Mickey Mouse generated by a computer.
And potentially generated by you, the user.
Right. If Disney Plus becomes a place for user-generated AI cartoons rather than just premium handcrafted stories, does that fundamentally change what Disney magic actually is? Is the future of Disney less about watching stories and more about prompting them? And if so, is that a future we actually want?
That is the billion-dollar question, and I suspect we'll find out the answer sooner than we think.
Thanks for listening to The Deep Dive. We'll catch you next time.